3 weeks. That is exactly how much time is left before the single most important supply chain shift of the last 50 years hits the global economy. While the financial media is busy celebrating the trade truce and talking about interest rate cuts, something terrifyingly specific is happening in the dark corners of the commodities market. Right now, as we speak, on December 12, 2025, the price of silver is hovering at $64 an ounce. That's a 115% move in 1 year. Most analysts, the ones you see on CNBC and Bloomberg, are telling you this is a bubble. They're telling you it's speculation driven by retail investors. They are wrong. This isn't a bubble. This is an evacuation. Because on January 1st, 2026, China isn't just restricting silver exports. They are implementing a mechanism so sophisticated, so bureaucratic, and so deadly to Western industry that most Wall Street algorithms haven't even priced it in yet. It's a kill date for the open market. I have the policy documents in front of me. I've looked at the shipping manifest from Shanghai to London, and I'm going to show you why the 660 tons of silver that left China in October wasn't a sale. It was a final warning. This is the calm before the freeze. By the end of this video, you are going to understand why your smartphone, your solar panels, and your investment portfolio are sitting on a fault line that snaps in exactly 21 days. And I'm going to answer the question that no one else is asking. Why did the US Geological Survey suddenly classify silver as a critical mineral only after China made their move? Does that sound familiar? It should, because we've seen this setup before, and every time it happens, the wealth transfer isn't just massive, it's permanent. Let's dive in. To understand why January 1st is the date that changes everything, we have to look at the deception that happened in November. You remember the headlines. Trump met with Xi Jinping. The markets cheered. Beijing announced they were suspending export controls on gallium and germanium. The trade war was cooling off. It was a masterclass in misdirection. It was a classic look here, not there strategy. While everyone was focused on rare earths, materials that are important but low volume, China's Ministry of Commerce, MOFCOM, quietly issued Announcement Number 68. There was no press conference, no fanfare, no international memo, just a bureaucratic update to the catalog of goods subject to export licensing. They kept one metal on total lockdown, silver, but they didn't ban it outright. A ban would have been clumsy. A ban would have triggered a World Trade Organization lawsuit immediately, and The Hague would have been involved within weeks. Instead, they did something smarter. They weaponized the bureaucracy. They created a licensing monopoly. Here is the mechanism that opens the first loop in our story, the mechanism that Wall Street is ignoring. Starting New Year's Day, if you want to export silver from China, you don't just pay a tariff. You need a specific state-approved license. To get that license, you must be a company that produces over 80 tons of refined silver annually. Do you know how many companies in China meet that threshold? Fewer than 20. And every single one of them, Zijin Mining, Henan Yuguang, the giants, is deeply connected to the state. They have party officials sitting on their boards. This effectively wipes out hundreds of small, independent exporters. The private market is being deleted. If you are a U.S. solar manufacturer needing silver paste for your photovoltaics in February 2026, you can no longer call a private trader in Shanghai and negotiate a price. You can no longer rely on the free market. You now have to negotiate directly with a state-owned enterprise that answers to Beijing. They have nationalized the supply chain without seizing a single mine. And they timed it for January 1st. Why? Because that is exactly when Western companies finalize their Q1 delivery contracts. It's a strategic ambush designed to create maximum chaos when American industry returns from the Christmas break. Now, you might be thinking, okay, that's just paperwork. Markets adjust. We'll buy it from somewhere else. But that assumes there is metal available to buy. And this is where the story gets terrifying. The physical market is telling us that the insiders, the people who actually move metal, not the people trading paper contracts, are panic buying. Let's look at the data that mainstream media isn't showing you. In October 2025, China exported a record 660 tons of silver. On the surface, that looks like healthy supply. It looks like China is open for business. But look deeper. Where did it go? It went straight into the vaults of the London Metal Exchange, LME, and COMEX warehouses in New York. This wasn't supply meeting industrial demand. This was an airlift. This was Western banks and smart money frantically pulling every ounce of physical metal out of China before the January 1st gate closes. It's like the last helicopter out of a war zone. They knew the window was closing, and they evacuated the inventory. Look at the Shanghai Futures Exchange inventory. In 2019, they held over 2,400 tons of silver. Today, as of this morning's report, they are down to 780 tons. That is a 67% drawdown. The cupboards are bare. And here is the loop that should keep you up at night. If China is the world's largest producer of solar panels, and they are running out of silver in their own vaults, why would they ever grant an export license to send silver to the United States? They wouldn't, and they won't. China's domestic industrial consumption has hit 5,200 tons annually. Their mines only produce about 3,600 tons. They are running a 1,600-ton deficit just to keep their own factories running. The export license system isn't about regulation. It's about survival. It's about hoarding. They are prioritizing their solar dominance over your ability to buy metal. Does this sound familiar? We saw this exact pattern with palladium in the late 90s when Russia tightened supply. We saw it with rhodium just a few years ago. When a structural deficit hits a critical industry, the producing nation shuts the door. And the price doesn't just double. It goes parabolic. But to truly understand the gravity of this, we need to talk about why this time is different from the silver squeeze of 1980 or 2011. In 1980, the Hunt brothers tried to corner the market for profit. It was greed. In 2011, it was retail speculation driven by fears of dollar collapse. In 2026, it is a procurement crisis. Silver is not just a shiny metal anymore. It is the blood in the veins of the modern economy. You cannot build a high-efficiency solar panel without silver paste. You cannot build an electric vehicle without 25 to 50 grams of silver in the contacts and battery management systems. And here is the kicker that tech analysts are just waking up to: AI data centers. The servers running ChatGPT, Gemini, and the entire AI infrastructure require massive amounts of silver for high-speed connectors and thermal management. Silver is the most conductive metal on the periodic table. It has the highest thermal conductivity. You want the AI revolution? You need silver. You want the Green New Deal? You need silver. But here's the problem. Unlike gold, which sits in a vault forever and is recycled at a rate of nearly 100%, industrial silver is consumed. It vanishes. When a Tomahawk missile explodes, the silver in its guidance system is vaporized. When a solar panel is buried in a landfill after 30 years, that silver is economically unrecoverable. We are burning through the world's inventory of silver at a rate of 1.2 billion ounces a year, but we only mine about 985 million. We have been filling that gap with above-ground stockpiles. But those stockpiles are gone. The airlift we saw in October? That was the last of the strategic reserves leaving China. On November 7, 2025, just 1 week after China announced the new restrictions, the US Geological Survey, USGS, officially added silver to the critical minerals list. Think about the timing. They waited until the trap was already sprung to admit there was a danger. The US government admitted we have a dependency problem that threatens our industrial base. If you are a US manufacturer, you have no plan B. You can't substitute silver in a circuit board without rewriting the laws of physics. If you switch to copper, you lose efficiency. If you switch to gold, the cost destroys your business model. You are stuck. If you can't get it from China starting January 1st, you have to bid for it on the open market against Apple, against Tesla, against Raytheon. What happens to price when you have price-insensitive buyers fighting for a shrinking pie? What happens when a missile manufacturer doesn't care if silver is $50 or $500 because they need the missile to fly? We have to pause and look at history because human nature never changes. Does this scenario sound familiar? Let me take you back to 2010. China controlled 97% of the global rare earth market. They got into a diplomatic spat with Japan over a fishing trawler incident. Suddenly, quietly, the shipments stopped. Not a ban. Just administrative delays. The price of neodymium went up 500% in 18 months. Dysprosium went up 2,000%. Western manufacturers faced an existential crisis. The U.S. scrambled to restart the Mountain Pass mine in California, but mines take years to come online. By the time the West adjusted, China had already used that leverage to force technology transfers and secure their dominance in magnet production. Now, rewind further. 1870. Britain was the world's superpower, the workshop of the world. But they relied on German steel. Germany started delaying shipments, citing quality control and domestic need. It was a soft economic siege. By the time Britain realized they were being strangled, German industry had overtaken them. It was a prelude to war. We are seeing the same script play out today with silver. China has moved from dependency, stage 1, to weaponization, stage 2. January 1st marks the beginning of stage 3, crisis. But silver is scarier than rare earths. Why? Because silver is a byproduct. This is the detail that makes the mining analysts lose sleep. 70% of the world's silver comes from mining lead, zinc, and copper. It comes out of the ground whether you want it or not. But you can't just go out and find a silver mine. Primary silver mines are incredibly rare. This means the supply is inelastic. If the price of silver goes to $200 tomorrow, copper mines cannot just ramp up production to get more silver. They are limited by the demand for copper. If the global economy slows down and copper demand drops, silver production drops too, even if silver prices are skyrocketing. The supply is constrained by geology. The demand is exponential driven by technology. And the valve is being turned off by our biggest geopolitical rival. And don't think for a second that Mexico or Peru can save us. Yes, Mexico is the #1 producer. But look at the political situation there. Look at the nationalization of resources trends in Latin America. And more importantly, look at who owns the refineries. China processes a massive percentage of the concentrates that come out of South America. The ore might be mined in Peru, but it gets refined in China. So what happens next? Let's walk through the timeline that the smart money is already betting on. December 31st, 2025, the old rules expire. The last unregulated shipments leave Shanghai. This is the cliff edge. January 1st, 2026, the licensing monopoly begins. The list of approved exporters, the oligopoly of 20, takes full control. We expect this list to be published any day now, and I guarantee you, there won't be a single Western-friendly trading house on it. January 15th, 2026. This is the date to watch. Mark this on your calendar. This is when U.S. manufacturers typically lock in their supply for February and March production runs. They're going to pick up the phone and realize the person they used to buy from is no longer licensed to sell. Panic will set in. We will see a supply gap of about 30 to 45 days. The new Chinese exporters will claim they are setting up logistics or awaiting MOFCOM approval. Shipments will freeze. This is designed to starve the market. During this freeze, spot prices in New York and London will decouple. We are already seeing premiums on physical silver hit $100 in Shanghai, while the paper price in New York is $64. That gap is going to explode globally. You will see a situation where the paper price, the spot price you see on your phone, says one thing. But if you want actual metal delivered to your factory dock, you are paying a 40% or 50% premium. This is called backwardation. It's a term traders use when the current price is higher than the future price because everyone wants the asset now. It signals extreme distress. And we are seeing backwardation in silver like we haven't seen since the failure of the London gold pool in the 1960s. And here is the loop I opened at the beginning. Why did the Fed cut rates today, December 10th? They know the economy is fragile. They see the cracks in the banking system. But by cutting rates, they just poured gasoline on the fire. A weaker dollar makes commodities more expensive. They are trying to save the stock market, but they are guaranteeing a commodity supercycle. They are trapped. They have to print money to keep the system liquid, but printing money drives investors into hard assets like silver. Let's be brutally honest about what this means for you. If we are right, and the inventory data, the policy documents, and history say we are, then silver at $64 is cheap. Bank of America and Deutsche Bank are forecasting $65 to $68. They are being conservative. They are afraid to look foolish. They are giving you linear projections in an exponential world. But if you look at the deficit math, if you look at the fact that 80 million ounces are vanishing from the market due to these restrictions, the equilibrium price is likely closer to $90 or even $100 per ounce by mid-2026. However, this isn't going to be a straight line. There will be volatility. The bullion banks, The big players with massive short positions are going to fight this. They are sitting on naked short positions that could bankrupt them if silver crosses $75. They will try to smash the paper price to force margin calls, just like they did to the Hunt brothers. They will use high-frequency trading algorithms to trigger sell-offs. But there is one thing they cannot do. They cannot print silver. They can print paper contracts. They can print ETFs. But they cannot print the physical element AG, atomic number 47. When Apple needs silver for the iPhone 18, they can't use a paper contract. They need the metal. When the US Navy needs silver for a torpedo, they need the metal. And the metal is gone. We are witnessing the end of the free market in critical minerals. The invisible hand has been replaced by the iron fist of state control. The era of cheap resources subsidizing Western consumption is over. China is keeping its resources for its own century. So, here is the bottom line. The supply lines are being cut in 21 days. The US government has admitted they are vulnerable. The vaults in Shanghai are empty. You have 3 weeks to decide if you believe the official narrative that trade is normalizing, or if you believe the data that shows a supply earthquake is imminent. History shows that when an empire loses control of its critical resources, the currency is the next domino to fall. Silver is the canary in the coal mine, and the canary just stopped singing. I'm going to be tracking the MOFCOM exporter list the second it's published later this month. If you want to see exactly which companies get the keys to the kingdom, make sure you're subscribed. This isn't about speculation anymore. It's about preparation. January 1st isn't just a new year. It's a new world order for commodities. Don't get left holding paper when the music stops.